Hey guys, Tyler Casey here. Um, this episode is going to be called How to Win in Real Estate in 2026, even if your prediction is wrong. Welcome to the second episode of the Ideas and Capital Show. I'm Tyler Casey. This show is about business, real estate, investing, purpose, and value, and more importantly, how to build durable wealth, not just the material kind, and create massive value in your community and the world for the long term, not to chase hype or headlines. Today we're talking about the 2026 real estate market. I hate to disappoint you, but this is not a prediction episode. I'm here to tell you, I am not here to tell you where interest rates will be this year or next year, whether prices will go up or down, or what the Fed is going to do next. Instead, I want to talk about how to win in real estate in 2026, even if all of your predictions are wrong. In my experience going through 08, 09, investing in stagnation from 10 to 14, investing in a boom from 19 to 23, and now seeing the backside of that cycle, most investors don't lose money because their prediction was wrong. They lose money because their strategy required them to be right. This is the prediction trap. One of the biggest mistakes I see investors make is building an entire strategy around a single macroeconomic belief. Rates will fall. This is the date the rate crowd. Prices will crash. This is the crowd who's been waiting to buy since 2014. Rents will surge. This is people just trying to make a deal work rather than assessing whether it works. Cap rates will compress. Yeah, right. In a lot of major metros, cap rates are a 5 or a 6 right now. They can't possibly compress. Investors can buy treasury bonds and make 4.5%. Here's the problem. If your deal only works when everything goes your way, it's not a deal, it's gambling. I've invested and operated through low rates, high rates, flat rent growth, strong rent growth, tight credit, loose credit, for 18 years now. People who survive and win are almost never the ones with the best predictions. They're the ones whose deals work across multiple outcomes. They're the ones whose deals work if rents stay stable. They're the ones whose deals work if interest rates go up a little. They're the ones whose deals work if they run over budget on a renovation. And they're the ones whose deals work when the value drops 10%. If your plan depends on perfect timing, aggressive appreciation, or a sale or refinance that has to happen, you're playing a dangerous game. So how do we avoid it all? First, underwrite for reality, not optimism. If you want to win in 2026, it starts with disciplined underwriting. We don't ask, what's the best case scenario? Do we look at the upside? Sure. But there's always a worst case, base case, best case analysis. We ask, what happens if this deal is painfully average or worse? What if we have flat or deflating rents? What if we have higher than average expenses? What if our lease up takes longer than we expected, or we have more vacancy than we expected? What if we have an inability to sell quickly or to sell at all? What if we can't refinance? If the deal still works under those conditions, now I'm interested. What that means is you have to have conservative rent growth projections, realistic expense projections, stress test against interest rates, and assume capital markets stay tight longer than expected. In 2026, boring and durable will outperform clever and fragile. You can't force a deal to be a deal just because you found it. Can creativity, expertise, and execution make a deal that doesn't clearly look like one to everybody else? Yes. But in general, drop the ego, just run the numbers. Second, cash flow is no longer optional. For a long time, people ignored cash flow, banked on appreciation, banked on future sales, banked on future refinances. They bought appreciation, they bought the story, they bought the refinance, they bought the future sale to someone dumb enough to keep paying more than they did. That environment rewarded leverage, it punished patience. That time period is over. Going into 2026, cash flow isn't a bonus, it's your margin of safety. Cash flow covers up mistakes. Cash flow buys time, even allows you to hold indefinitely. Cash flow will keep you solvent. Cash flow lets you hold when others are forced to sell. The one caveat to this may be those who bought in the 2020 to 2022 window at peak or near peak prices with 3 to 4% interest rates. Your cash flow may have been temporary, but if you had substantial enough cash flow, it may still protect you. You may be screwed when your note balloons. This is where smart, conservative, long-term financing saves you. This is where substantial equity in deals saves you. If your deal barely cash flows or doesn't at all, you're betting on forces you don't control. Winning in 2026 means prioritizing in-place income and expense discipline. And number 3, operations will, in 2026 and always, drive returns. So here's a truth that doesn't get talked about enough. In uncertain markets, operators outperform investors. When appreciation slows, operations become the return. That means better, more efficient property management, efficient maintenance, fast turn times, high-level construction execution, great tenant screening, systems, data. Small improvements really compound. Better collections, faster turns, lower waste, smarter vendor management. In 2026, you won't win by guessing the market. You never will. You'll win by running better buildings than the guy next door. That's what we've always done. And this is exactly why passive investors often do better partnering with experienced operators instead of trying to be part-time experts. Number 4, how you win in 2026? Flexibility beats certainty. Most people are waiting for clarity. Don't be the guy who waited for the bottom only to lose a decade of income, debt pay down, appreciation, tax benefit, etc. In a 30 to 50 year investing lifetime, you better act today, even if that turns out not to be ideal timing. Just avoid ever making investments too big for your current net worth or your current liquidity. These people who wait, they want rates to stabilize or drop. They want prices to bottom. Good luck catching the falling knife. Or the economy to make sense. Good luck with that. When's the economy ever made sense? Especially over the next decade with AI. The future is always scary. We went from horse and buggy to automobile. Went from telegraph to telephone. We went from fire to electricity. If you waited to do everything until it was certain, you'll be dead before you're either rich or happy. Clarity is expensive. We don't have time to wait to invest. Our lives are too short. By the time certainty shows up, you've missed all the best opportunities. Rapid and repetitive action usually beats the best laid plans. Winning in 2026 means building flexibility into your strategy, multiple exit options, sales refinance, seller carry, buying so conservatively you could hold it forever. Conservative leverage. You should make sure you have enough equity that if the market takes a short-term drop in values, you can still sell if absolutely necessary. Better if you don't have to. Better to make sure you can be in a position to hold during market downturns. Long-term debt when possible. The more certainty you can lock in, the better. The ability to hold longer than planned. This to me is the most critical. I go into every deal I do with the thought that I'll hold it forever. Even though I won't actually ever hold anything forever because tax considerations with 27.5 and 39-year depreciation schedules dictate a different strategy. So if your deal forces a sale or refinance on a specific timeline, you could already be screwed and you just don't know it yet. The goal isn't to be right next year. The goal is to still be standing 10, 20, 30 years from now. So to kind of wrap this all up, every market cycle rewards something different. Boom markets reward speed and optimism. Challenging markets reward patience and discipline. I think all markets reward patience and discipline ultimately. I think 2026 will reward investors who don't need to be right, don't panic, don't over leverage, focus on fundamentals and execution, and play the long game. And I think that always wins. If your strategy works, whether the market goes up, sideways, slightly down, you've already won. If you disagree with this, I'd love to hear why. Drop a comment, send a message, tell me where you think I'm wrong. If this episode helped you, share it with someone sitting on the sidelines waiting for the perfect moment. There will never be a perfect time. Maybe watching this will get them off their ass. I hope you enjoyed. Thanks for listening. I'll see you on the next episode of the Ideas in Capital Show.